Canada's 5-year fixed mortgage rates are closely tied to the country's 5-year bond yield, which is influenced by the U.S. 10-year Treasury. Amy Davis has more on this story.
Thanks for having me.
What's been happening with mortgage rates recently?
Well, just 2 months ago, rates had fallen sharply because of U.S. tariff concerns driving bond yields down. Now we're seeing the opposite with bond yields rising, causing some big banks to adjust their rates. Interestingly, Scotiabank is going against this trend.
Can you give us more details about these changes?
Sure. Canada's 5-year bond yield has increased from around 2.50% to 2.85% today, and fixed mortgage rates have followed suit. CIBC and RBC have each raised their 5-year fixed rates by about 10 basis points. TD also hiked select terms, with increases of 10 to 15 basis points. Meanwhile, Scotiabank is actually lowering several of its rates, with some cuts as steep as 90 basis points on its 1-year term.
How are global factors influencing our mortgage rates?
Canada's 5-year fixed mortgage rates are closely tied to our 5-year bond yield, which is heavily influenced by the U.S. 10-year Treasury. This means our mortgage rates are often shaped more by global forces than local economic conditions. As Bruno Valko from RMG explained, what influences the Canadian bond isn't necessarily what's happening in Canada, but rather what's happening with the U.S. Treasury, which can be affected by many different factors.
What are some of those factors affecting the Treasury market?
Well, there are some less obvious factors like investor confidence, the U.S. deficit, and fears of stagflation, which is when high inflation happens alongside stagnant growth and high unemployment. Economic uncertainty from unpredictable tariff policies might also be causing foreign buyers to purchase fewer American treasuries. There's speculation that countries like China are reducing treasury purchases and may be buying gold instead, which means yields go up as the treasury tries to attract more buyers.
What does this mean for people shopping for mortgages?
There's a high level of volatility in the U.S. right now, which makes even well-informed forecasts uncertain. Jerome Powell, the American Federal Reserve Chair, doesn't seem certain about interest rates because of how tariffs might impact growth and inflation. So it's hard for anyone to be confident about whether variable mortgage rates will come down. Valko suggests that risk-averse mortgage buyers who can afford current rates might want to consider a 5-year fixed product for peace of mind.
Thanks for breaking this down for us, Amy.
Happy to help.
Canada's 5-year